Hey everyone, John Henry here from School of Trade, and today we're going to be taking a look at the spike and ledge pattern. So this pattern was originally defined a while back by both Larry Connors and Linda Raschke in the book Street Smarts. Now, essentially what the idea is behind this pattern is that you're looking for an area of just big volatility moving into a consolidated area and then a failure out of that location. So as an example, we've got a couple different spots here. This is just crude oil on a 5-minute chart. And as you can see here, we're coming up and we just kind of make this move, but all of it is just a burst straight up to the upside. And we move into this big block of consolidation where we're not really going higher, not really going lower, not really kind of going anywhere. Well, really what we're looking to do now is we're waiting for this consolidation area to fail, and we're going to take a short right back down. So the entry to find this area is basically you're waiting for a candle to close outside of the consolidation area. So once you find this ledge, what you're doing is you're looking for the entry trigger of the candles to close outside of that trading range, and that's going to trigger, in this case, an entry short. So your entry is right here to the downside. Now, we're entered in, but where do we place our stops? Where do we place our targets? Well, the first things first we need to place our stop, and our stop loss is going to go right above the highs of this consolidation range. So, you can place it right at the high. You'd probably be better off just placing a couple ticks above the high, but, once we're triggered in short here, then you're looking to place your stop right above the top here. And now that we've got our stop in our entry, where do we place our targets? Now, when we're looking at the spike and ledge pattern, you're actually looking at a couple different target locations. The first point is going to be the 50% retracement of this move. So from the low point to the high point, you're looking at the 50% area right there for your first target. So the first target's at 50%, but where does the second target go? Well, the second target's going to be targeting right back down to the lows again. So you've got a couple different options in terms of how that goes, but you're looking at target 1 at 50%, second target right down at the lows. Now, this works both directions, both long and short. As an example, we've got another long one the same day, get a nice burst to the upside, and we move into this area of consolidation. And we're just kind of chopping back and forth. We're not really making kind of headway either direction. And all of a sudden, we get this nice close outside of that consolidated range. So that's going to be your entry. Stop goes right up to the top again. And now you've got a couple different options in this type of example. You've got the overall swing low that moved into that area right here. So that could be the first target, as well as a 50% move right there. But you've also got a couple other swing levels too. So you can target the lows here with a 50% in this about the same area, or all the way down to this low here. Typically, I like to use the lows prior to that spike higher. So in this case, it would be this one right here. So that's taking a look at the spike and ledge pattern. If you have any questions about it, feel free to send an email to School of Trade. And don't forget to check out our trial at schooloftrade.com. Have a good one. Bye.